Welcome to this episode of PhillipCapital's Market Watch. My name is Paul Chew, Head of Research at Phillip Securities Research. Today, I'll be discussing our Singapore equity strategy for fourth quarter 25 titled Follow the Money. Let us begin with the macro theme that sets the investment backdrop for fourth quarter 25. Despite concerns that tariffs could drive inflation higher, we expect inflation to trend lower than expected in the US. While tariffs may cause a one-off impact on inflation, this effect is likely to fade. Firstly, around 30% of the core inflation measure comes from goods, and only 8 to 9% of this is linked to direct and indirect imports. Secondly, we see disinflation in wages, rent, and energy costs. Therefore, any tariff-related spike in inflation is unlikely to spill over into broader services or wage inflation. We expect a productivity boom to be underway in the US and potentially globally. US GDP remains resilient, rising by 6% year-on-year in second quarter 25, supported by a rebound in corporate spending and continued government deficit expenditure. Despite the strong GDP, US payrolls, particularly in the private sector, have contracted. This suggests that corporates are prioritizing AI initiatives and automation to drive growth rather than expanding headcount. We view this as the early phase of a productivity-led growth cycle fueled by AI adoption. Singapore is currently experiencing a huge inflow of liquidity. Foreign reserves, including transfer from the central bank, have doubled from pre-pandemic levels of around US $283 billion to nearly $600 billion today. This surge is driven by Singapore's substantial current account surplus and its safe haven status as the only AAA-rated sovereign credit in Asia. The spike in liquidity is ballooning deposits and driving down interest rates in Singapore. The overnight interest rate in Singapore, or SORA, has fallen by almost 200 basis points over the past year to around 1%. While global markets wait for further US Federal Reserve, Singapore's rates have already adjusted equivalent to the Fed cutting 8 times in a year. Lower rates reduce borrowing costs and support valuations across all major asset classes. The collapse in domestic interest rates has made Singapore equities increasingly attractive even after their 14% rally this year. A key valuation metric is the earnings yield, which is the inverse of the PE ratio. Currently, investors are compensated with a 5.3% premium for holding equities versus bonds, above the long-term average of 5%. This widening spread reinforces the relative appeal of equities in a low-rate environment. In conclusion, Singapore equities have long been considered undervalued, sometimes even a value trap. But we now see a catalyst emerging. We think the collapse in interest rates and investments from the central bank into Singapore equities will be the key event as flows drive up asset values. The Singapore dollar 5 billion Equity Market Development Programme, EQDP, will channel more institutional funds into Singapore's public equities market. On top of the 5 billion is EQDP Plus, where selected EQDP fund managers are required to raise even more funds for investment in Singapore equities. Sectors of Singapore equities we favour are REITs, banks, property, building materials, and small caps. With that, I'd like to end this episode of PhillipCapital's Market Watch. Do remember to like the video, subscribe to us on YouTube, and follow us on our social media handles. Thanks for joining us and see you soon.